Hello traders, Gary Wagner here, just about 10 o'clock in Honolulu, 3 o'clock in New York on Friday. Happy Aloha Friday, as we say on the islands, the 27th day of November, 2015, and this is the daily report for gold and silver, our weekend review. And although we've had shortened trading sessions today due to the holidays, we certainly have no lack of action in the market as we have gold trading off $14 on the day, breaking through critical areas of support. 1058, that's our current print, the low 52.95, the high 73.87. Now, in terms of percentage drawdowns, we saw gold off roughly 1.33%, with silver off almost 1.5% off 21 cents, hovering just above 14 at 14.04, the low 13.96, the high 14.30. So platinum and palladium also trading lower on the day, but in terms of percentage drawdown, not nearly as much as gold and silver, about 0.5% in palladium, 548.50. And when we look at platinum, platinum is off roughly 1% on the day, down 870 at 835.20. So as we enter the evening and weekend and await Monday's trading, the real question has to be whether or not we have seen and sustained any long-term damage on the charts with this most recent action, this $14 decline in gold. First thing we'll look at is a very, very short-term chart just to kind of get a feel for the activity that we saw transpire today. And you can see that as the market opened, the 27th comes in right here. And from the moment that we started trading in the markets, you can see that we had a dramatic drawdown the first 2 hours of trading. That would represent this one bar right here. That is a 120-minute bar, a 2-hour bar. We then, on the next cycle, the next 2 hours, we sustained a lower low. This is where that 53 came in. And then we had a little bit of settlement and sideways action as we see the market closing at 1058. That's short term. But when we look at some of the longer term studies, we can see that, at least in my opinion, we have had some dramatic price action in the market with these most recent drawdowns. Now, I draw your attention to this particular chart. It is a weekly chart. The candle that we are looking at represents trading Monday through Friday. That's this candle right here. My sense is that once we literally broke through 61, this was the most recent low here, we are now in no man's land. And what I mean by that is to see or to match any of these lows that we have seen over this week, we really have to A, compress the chart, and B, go back over 5 years to see that price point. So traders, I have done just that. I've gone ahead and compressed the chart. Now on this chart, we have two basic fib areas, both of which have absolutely been broken through. One fib retracement, the real long level fib retracement, starts just below 300, 263, takes us up to the top. The second fib retracement level starts at 681, takes us up to the top. Those, of course, are the shorter lines here and here. Now, first of all, when we consider the 50%, and this is where I put pretty much a major emphasis on, the 50% retracement is 1092. We have clearly now broken below that price point. We broke below the 61% of this shorter area at about 1153. The next real levels that we're looking at, as I said, we have a minor level at 1039, but our major level is the 75% retracement level. That's a retracement of this shorter move here, and that takes you to 990. There's our $1,000 mark. And I really think at this point that gold is probably going to trade back to $1,000, and that you can see is former resistance, which I believe should become support should this market continue to drift lower. Below that is a 61% retracement of the long move, and that 61% retracement of the long move comes in roughly at $900. So we absolutely, I believe, once we broke below this particular price point, we did that over the last couple of weeks, we are in a territory that we've really not seen this market trade at since about the end of 2009, right in this area here. That's the last time we saw this market move up to this point and then back to this area, having a little bit of support here, but we've clearly at this point now broken below that particular price point. What does that mean for the price of gold? What does that mean for the price of silver? My sense is we will see lower pricing. We can initiate short positions on Monday. Stops will just simply have to be above the most recent highs in the market over this last week. And to do that, of course, we've really got to go back and look at our weekly chart. Let's go ahead and do that. And so the high of this week is coming in at around 1079. And so your stop is you're going to want your stop above there or this low right in here. This low right in here being at 1068. So that's where you can place your stops, assuming that this market does not open and really rally up, which I find a strong stretch in terms of what we've seen in the most recent moves in the market. So traders, is food for thought, so to speak, over the weekend. One of the things that I took a look at the other day was comparing the U.S. equities markets vis-a-vis the Standard & Poor's 500 against the price of gold. And the lines that you see, these blue lines here, this stands for the initiation of quantitative easing 1, quantitative easing 2, and quantitative easing 3. So I really wanted to see when we saw a separation, and most importantly, we saw this market at first somewhat moving in tandem. You can see quantitative easing 1 moves the price of gold substantially higher. It also moves the equities markets higher. From there, kicks in quantitative easing 2. Definitely. Well, this takes us to the top of the market, this being 1900 up here. And we also had this market sustain a rally, get to the former top of the equities markets before correcting. We saw corrections happen both in the equities as well as in gold, but then we kicked in with quantitative easing 3, this being the last part, and this being the component where they added twist and a couple other items. But as you can see here, this is where we really see the market, and this comes in roughly the beginning of 2012. We had already had this market really top off at about 1800. Those are the highs that you see here in gold. But what we do see is that once quantitative easing ended, that really took the upside momentum in gold and fizzled that out because the monetary policy had changed. But the equities markets really, with all that cash infused in it, really began to ramp up to a record high. At the same time, we saw gold start to trade to new record lows. And we have seen this market now between the gold market here and the equities market here really move counter to each other as we have approached new highs and hit new highs in the equities, and now we are hitting new lows in the precious metals markets and gold market. And when I say new lows, I'm talking about lows that haven't been seen for the last 5 years. So when we look at this in terms of the fundamentals, meaning monetary policy in the United States, the effect on equities, the effect on gold, we can absolutely see that at this point, the negative effect that this has had, the positive correlation that the quantitative easing program had in equities throughout the end, and that leads me to really be suspect of where we could actually see this market go. Now, we're looking at simply a daily chart, and I pulled this up so we could look at the current bottom that we've seen, the low in the market, and I kind of match it to that low right there in the bottom. We'll take this all the way across. Could we see support in this area based upon these lows? Well, we could see support at any point, but I really don't see a reason for it. But we genuinely, and this is what to me is most interesting, we genuinely broke below these series of bottoms that we had formerly in the market. Now, the last time we had a major break below a series of lows, and I draw your attention to these lows that we saw back in 2011 and 2012, markets at 1920, comes down and finds support. I believe this area was around 1534. I kind of recall that number. And that was the lows in the market, but we also had highs in the market coming right in at 1800. The market definitively traded between this band here. But when we broke, it broke extremely hard and genuinely took this market from 1500 plus down to these lows at around 1200 here. That was the next real base. Now, this market here you can see that when it broke below the 1200 base, it meandered and it actually oscillated above and below that price point. So we can effectively see areas where we had extremely hard breaks in the market, such as here, and areas where we did not get hard breaks in the market, such as here. Now, when the market finally did break below this particular point, you did get a pretty sizable price drop. So my sense is that we absolutely have the ability in this market for lower pricing. And as I said, 1039, first area level of support we'll look at if we see continuation in selling. Second level, $990 to $1,000. This has been Gary Wagner wishing you, as always, good trading. We'll talk to you on Monday for another daily update and review. Bye-bye.